Welcome. You're watching Bloomberg Quint. We're in the Bloomberg studio in Midtown Manhattan, and I have with me Viral Acharya. He's the C.V. Starr Professor of Economics in the Department of Finance at the New York University Stern School of Business. Professor Acharya, thank you very much for speaking with us. One of the things I wanted to focus in our conversation today was not just for your assessment of India's macroeconomy, but also how India's banking system or financial system has been plagued by the problem of bad loans. But let me start first by what you make of how far the Modi government has come in the little over 2 years that it's been governing India, and where you see the economy of India right now. Do you believe firmly that it's on the path of recovery?
Yeah, I would say we are certainly on the path of recovery, and it's particularly helped that we probably look the best in terms of growth prospects, as well as last 2 years of growth not just among emerging markets, but actually including the developed economies. Of course, we have a long way to go, but I think gradually the reform plans are coming into place. I think the fact that we managed to get the GST bill passed through the government is, I think, a big positive, to the world, more as a signal that the processes and the bureaucracy is functioning rather than just stalling all the critical projects. I think, the road and the railway infrastructure is also gradually on the upswing. So I would say by and large we are in good shape. What I'm most worried about, if anything, is sort of global headwinds to growth. I think Europe, in my opinion, is still sort of just teetering on not falling into recession. There are parts of Europe that look pretty weak, especially the Italian banking system. And now even the German banking system is actually not looking that great, with two of their largest banks not looking that good. Japan is constantly in and out. Brazil, Russia, China. Everything is on a slowdown. China could be in it for a pretty long haul, given the extent of disinvestments and deleveraging that their banks have to go through. The US and India, in my opinion, are sort of like the knights with the shining armor right now. So,
one of the things the world seems fairly sanguine about, though I do know that experts in markets and finance have been talking about it, is the amount of money that currently earns negative interest rates, and nobody's quite sure what the ultimate outcomes of all of this will be. Have you been able to sort of try and look at this and say, 5 years down the line, we're going to have to pay the price for all of this, and what that price is going to amount to?
Absolutely. I think partly it's a very hard question because we are in a somewhat of an uncharted territory.
Correct.
We don't have historical evidence as to what has happened when we've allowed interest rates to go negative. But I think the history is telling in some ways already. We know what happened in Japan in the 90s, which is we didn't recapitalize their banks, but Bank of Japan said, I'm going to give you a lot of cheap liquidity. It wasn't at negative interest rates, but it was cheap liquidity.
Right.
And what did Japanese banks do? They just rolled over bad loans, extending the maturity by another 3 to 5 years. Those bad sectors of the economy where they didn't want to recognize the losses, the banks, the rolling over of credit meant that the resources were getting hogged in the worst parts of the economy. Now, of course, we realize that only with the benefit of hindsight. But right now, exactly the same thing has happened in Italy since 2012, when European Central Bank, they had limited resources, but banks didn't get recapitalized and they threw cheap liquidity at them. And what happens with rolling over of bad loans is that at a macro level, it looks fine. It looks like credit is growing. But unless you go and observe what the banks are doing at a micro level, which is that they're actually not recognizing losses, they are simply papering over the losses for another 3 to 5 years, you don't actually diagnose the problem right. And I think this is the fundamental problem I have with negative interest rates, which is that the gains have not been, demonstrated. We are yet struggling to figure out what are the global economy's gains from the ultra loose monetary policy, whereas now we are seeing emerging evidence of the unintended consequences that these policies have had. So the biggest problem I worry with low interest rates is when your parts of your banking sector are not healthy, it's a recipe for disaster.
Speaking of parts of the banking sector not being healthy, how do you react to what's gone on with Deutsche Bank over the last few weeks? You made a mention of weakness in the German banking system, and who would have thought even a few months ago that we would be sitting down and talking about weakness in a bank in a country that was the one standing pillar of the Eurozone, right?
So I'm not too surprised. From our research at NYU Stern's Volatility Lab, we've actually been saying for the longest time that the French and the German banks are actually not as well capitalized as they look to the regulators. The trouble with the regulation of bank capital is that it follows very static rules. They don't change with the changing nature of risks in the economy. And because the rules are not evolving in an intelligent way, banks game them very thoroughly. One of the problems is that many assets are marked for ratings by the banks themselves,
right,
which has a huge conflict of interest. It doesn't take much to realize that this could be a big issue. So French and German banks have been trading at market to book ratios of below 0.7, 0.5, whereas US banks are trading at 1. Now, partly this reflects lack of growth prospects in Europe. Partly it reflects the fact that the books aren't getting marked as well as they should be. So I think in some ways the European banking sector as a whole to me is a little bit like a ticking time bomb. I was surprised to read today morning that even now they've come out saying we are going to push back on any capital reforms. We are not going to request or force our banks, which is what they really need to do, to raise more capital. So, the fact that Deutsche Bank has hit the news is perhaps more surprising because they are a national champion, etc. But I think that's part of the problem. I think the creditors in these banks still don't think they're going to take major hit. It's really the shareholder equity that's getting wiped out. And ultimately, I think it's the taxpayers on the hook. So by turning a blind eye to the fact that the market doesn't think Deutsche Bank is capitalized well, I think the regulators are risking taxpayer money, in my view.
Are you proposing that there ought to be a bailout? The bank is denied asking the government for help. The government says we don't intend to help at this point in time, or so are the media reports. But do you think that's the only solution in sight?
No, I don't think that's the only solution. Like, why should the bankers be bailed out? Why should the creditors be bailed out, especially the subordinated bondholders? I think the right thing to do is to shrink the size of the bank. They should probably sell it off in smaller units, allow foreign capital to come in and buy the franchises of Deutsche Bank. Now, this is where the conflict between being a national champion versus achieving the market outcome arise. But I think that again and again we tell large banks, the systemic banks, the systemically important banks, the national champions, that listen, every 10 years you can fail and you can still exist for another 10 years to fail all over again. And I think we need to stop that cycle.
Okay. Speaking of banks in Europe, look, banks in India don't have it much easier either. The last few years, part of the India story has been about being able to resolve the mounting bad loan crisis that the country has faced for a variety of reasons. Corruption, just poor judgment on behalf of banks. And then we had a long period of political, let's say, inactivity that led to many projects getting stalled and hence becoming bad on the books of banks. I think some data I'm going to throw up to you from a story we did on Bloomberg Quint. Impaired assets at banks are now at 12%, with non-performing loans accounting for about 8.6%, restructured loans accounting for the remaining 3.5%. And Credit Suisse, in a recent report, said it expects the overall ratio of impaired assets to rise from 12% to over 16%. Clearly, this problem is not behind us. How do you assess it? You've written extensively about this and about the impact on public sector banks in India.
Yeah. So I would make three points here. So the first point I want to make is that while these numbers already look quite large and staggering, when you separate public sector banks and private sector banks, it looks even worse, which is that the losses at public sector banks are even larger than the average losses.
But they've done most of the infrastructure
Yeah, they've done most of the infra, steel, power.
You're
You're absolutely
private sector banks
right.
have just steered clear of all of these assets. So,
so that's one point, which is that ultimately we have a problem here like a Deutsche Bank one, which is that the banks that are getting into trouble are the ones where we don't have good mechanisms to actually resolve them. Now, second point is that historically, any bank distress in India has been resolved through mergers. Banks in India have typically not failed except for the very small banks here and there.
And the regulator steps in, forces two of them to merge.
Exactly.
And hopes that the problem will go away over time.
But the trouble is that a public sector bank cannot actually, under the current statutes, be sold to a private sector bank. Now, what our research shows is that there are banks in the private sector like HDFC, Kotak, which actually are so well capitalized that they actually have balance sheet capacity, in my opinion, to take over some of the healthy parts of the activities that the public sector banks are engaging in. Clearly, public sector banks have a branch network and franchise that would be very valuable even for private sector banks. Now, the right creative destruction, in my opinion, for this is that even if we can't repeal the legal statute that easily, that okay, you can't sell an entire public sector bank over to someone else, we need to find a minimum level of transfer of assets, branches, franchise that is possible from unhealthy parts of the banking sector to the healthy parts of the banking sector. I think the reason why this is important is because we need to wean the banking sector of the government, implicit government guarantees and subsidies that the public sector banks enjoy. We need to allow the private sector to grow if they have been healthy. I'm not saying we need to make a mission out of making the private sector grow, but if they are performing well and public sector banks are not, private sector banks should actually be rewarded for doing this. Right now, we don't have mechanisms to do this. And the third point I want to come down, which is I think very important and I think is not getting stressed enough, which is that our growth numbers are good, but they could be much better.
Right.
Because right now what's happening is that the public sector banks, which clearly receive a big chunk of the deposit savings in the economy, are not lending well at all. They are rolling over bad loans. A big chunk of their assets are stuck in restructured category, as you mentioned from the Credit Suisse report. And third, their credit growth is actually very stagnant. So healthy parts of the economy could actually be getting cheaper credit if we resolve these problems quickly. So I'm hoping that the Reserve Bank of India and the Modi government work out a market-friendly solution to this problem rather than saying, let's just kick the can down the road, which is what Japan did in 90s, which is what Italy has done in the last 5 years. And I'm worried that is what Germany is going to do right now. I think if we really stand out and do the right thing, I think we could push the Indian growth rate above, maybe by 1, 2, perhaps even to 10%. I think that's entirely possible in my view.
Okay, so you've raised some very interesting points here, and I want to very quickly address each one of them. When you suggest that you try and separate out the good parts of a public sector bank from the bad parts, for instance, the branch network, which somebody else might be interested in, you're in effect also suggesting that maybe we create a bad bank. It's a thought and an idea that keeps coming up. It came up in the US during the time of the financial crisis. In India, we haven't really debated this in any big way, but is that what you're suggesting? That's one. Second, you suggested that maybe a private sector bank like HDFC Bank would have enough capital to acquire this. But in this day and age of technology, are banks looking to beef up on branch networks as much? Would they be willing to pay at all for anything like this, or would they be willing to pay very small amounts? And therefore, is there really anything good left in the good part of that banking system? Especially because many private sector banks have stayed away from funding large projects, which has really been the core of what the state banks of India and all of them do. So would an HDFC bank even want exposure to those kinds of projects? So if you can elaborate a little bit more on what type of solution you're referring to here.
Yes. So let me take the two questions one by one. I think the first question, I'm absolutely proposing either explicitly or implicitly that we separate the healthy parts of the troubled banks from their unhealthy parts.
So you are talking about a good bank, bad bank solution.
Yeah, either as a bad bank that is left as the bad assets on the original balance sheet once you have separated out the good parts, and either you could just let it run to maturity, so you're not looking for sellers, buyers or something like that. Or you could actually pool all the bad parts together and form up like an asset management restructuring company that looks for buyers of these assets.
And you think that's a viable solution?
It takes time because bad assets have a lot of adverse information about them.
Yes.
But usually over a 4 to 5 year period, historically, in most parts of the world, there have been buyers of these assets. Of course, you're going to have to sell these assets at a discount, but the governments usually have managed to get something out of these bad assets. But in many countries, bad assets have also simply been run to maturity, which in my opinion is a much better outcome than actually reining in the healthy part of the balance sheet because it's constantly being pulled back to paper over the losses of the bad parts.
If I remember correctly, the US did something quite similar, right, after the global financial crisis.
So they did this in 90s as well.
They did it. You thought it was a success.
Implicitly, US has always done this through Fannie Mae and Freddie Mac, which are their sort of big mortgage giants.
Right.
But in 90s, when they had the savings and loans crisis, first they had a bailout, but ultimately they set up an asset restructuring company, and in 95, the government exited after 5 to 6 years once this restructuring company was set up.
So you don't think this piecemeal recapitalization we've seen the government do when it comes to public sector banks is going to be effective enough? Really, in your, at least from our conversation, the one solution you're backing is a bad bank, good bank solution.
Yeah, I don't like the piecemeal capitalization at all, because it's going to mean also very gradual recovery of the credit growth at these banks.
Yeah.
And that's not what the economy needs right now. I understand from a fiscal standpoint that's an attractive way of going about it, but I think our focus should be on growth. And I think the point is that if the government feels fiscally constrained for injecting more capital, that's precisely why they need to relocate some of these assets into the healthier parts of the banking sector, because that reduces the onus on the government on how much they need to recapitalize, because there is spare capital sitting in the private sector.
The private sector doesn't want any exposure to this, Professor Acharya. If it wanted to, you would have seen the private sector step up and, lend to many of these projects, whether they're steel companies or road companies. They never did so over the last 5 to 7 years, maybe smartly so now in hindsight. Why would they get involved now?
So I would make 2 points.
Unless they were getting it to pennies to the pound.
Yeah, so I would make 2 points there. One is that clearly 75% of our banking assets are with the state-owned banks.
Yes, absolutely.
So there are many parts, even in the healthy parts of the even in the healthy sectors of the economy, there's a lot of lending that happens by the public sector banks. So clearly that share could get easily transferred over, in my opinion, to the private sector banks. Okay. Private sector banks could grow in lending to the healthy sectors if big chunk of the deposit savings are not just automatically getting funneled into the public sector banks, regardless of what their quality is. Because, once you have an India or a Maharashtra or a state's name in the name of the bank, the depositor knows this bank is implicitly very, very safe. It's going to be.
But in effect, what you're suggesting is also possibly the last nail in the coffin of the public sector banking system in India. You're saying, let's find this right solution, let's make the tough decisions, and even if it means that PSU banking in India, effectively comes to an end because of something like this.
Yeah, I'm not even saying it should necessarily come to an end. I'm just saying that those who are distressed should be gracefully made to shrink. Okay. And if others get distressed in due course, maybe that means it is the final nail on the coffin. But I think, you look at the last 25 years of private sector growth, private banking sector growth, it's flat.
Right.
Indian private sector banking has not raised its market share beyond 25%. In fact, it shrunk after the 07-08 crisis because depositors, especially the corporates, flew back into State Bank of India and other banks. The last point I would make is that I think the deposit franchise of these public sector banks ought to be quite valuable to the private sector banks, in my view, because there are certain parts of branching restrictions that have never been that openly available to the private sector banks without them actually getting into priority sector lending, etc. So the government, on the one hand, along with RBI, has been relaxing the priority sector norms to make it so broad that it's really not a priority sector norm anymore. Yeah. But now we should reap the full benefit of that by saying, let me get some of these rural branches of the public sector banks even into private sector banks, because I think the lending restrictions are not as strict anymore.
All right. The solutions that you have sounded out right now just require, I think, a lot more courage than maybe politicians in any country have to undertake, especially because this is such a sensitive issue, right? There are unions involved, depositors involved,
absolutely. Yes,
and laws involved and all of that. So I'm not going to suggest that this is going to be easily accomplished, but it does give us a talking point to start looking at solutions that are more serious in nature, because so far every scheme that the RBI has come up with, whether it was the earlier CDR scheme as it was called, or now even the strategic the SDR scheme, so to speak, which allows for banks to convert debt into equity, or thereafter I think the S4A scheme more recently. I mean, every effort that the RBI has made to help resolve this bank loan problem has just not seemed strong enough.
Yes.
In fact, I'll continue to quote from that Credit Suisse report. It says that we estimate that another 4.5% of loans are stressed, and therefore expectations of a turn in asset quality cycle at this point in time seem rather premature, right?
Yes.
They're referring to the power sector, where an Uday kind of scheme might still not, yield much. I could go on and on about the sectors that are in difficulty in the country, but I won't. Do you believe that the RBI has also not done enough to recognize this problem?
I would say yes and no. In my opinion, RBI could have potentially acted a little earlier than they did. I think maybe the asset quality review that they undertook could have actually been started in 2013-14 itself, when I think there were signs. In fact, there was a Credit Suisse report in 2013.
Yeah, the house of debt,
that suggested that we had a problem in our house. Nevertheless, I would say that the asset quality review, tough marking down of bank losses, requiring recapitalization, along with, you have to work with the government, unfortunately, when you have a public sector banking in such a large measure. To get these banks to be recapitalized to healthy levels is the only way to go, in my opinion. And I would actually say that even at the cost of having a short-term, I would say a little bit of a shock to the market in terms of the recognition of losses, is perhaps not such a bad thing. Like, think about which banking sectors out of the 07-08 crisis have come out well. It's the US banking sector. Why? Because they took the biggest pain. They took the biggest hit. What did they do? In fact, they took an actual serious bank failure, right? They took Lehman Brothers, Wachovia, Washington Mutual. Why did that work? Because it aligned political thinking with the economic needs of United States banking sector at that point. And it's that alignment which is most important. And I find that gradual recognition of losses doesn't escalate the matter to a point that it needs to be. So I'm not suggesting we should have a full-blown banking crisis.
Right.
I don't think we need that. But I think we need to be tough in marking down the losses of banks to ensure that the capital needs are being correctly assessed, and have an open dialogue with the government that, listen, if you can't inject the capital, let's figure out an alternative way of transferring some of these assets and branches into the private sector.
Okay, so you've said a more realistic recognition of bad loans, some of which is already underway, definitely more recapitalization, the absence of which will mean that we should look at a bad bank, good bank kind of solution.
Yes.
Right? Now, if these were not to take place, because these are right now not part of the active agenda of the government, there is some recapitalization happening, but not necessarily as much as these banks need. Where do you think we are in this NPA cycle? Do you think we have another 2 to 5 years of pain to face, or do you think it might be a shorter term period of 1 to 3 years, or do you think we're over the hill now?
That's the problem with kicking the can down the road, which is you can't actually attach a very clear timeline to when your problems are going to get solved. Because if you let a wound fester, you don't know what extra problems it's going to actually lead to. So I don't have a good sense of what it is. What I can definitely say from historical research everywhere is that it's well-capitalized banks that lend healthily to the deserving parts of the economy. Undercapitalized banks either don't lend, or if they are thrown cheap liquidity at, they lend to the wrong parts of the economy. So I don't know when we can end the cycle, but what I know for sure is that it's at least 2 to 4 years. And what we can do, which will actually bring about a turnaround quicker than that, is to actually recapitalize the banks expediently over the next 1 year. So my sense is we don't need to have a clear sense of when we can get out of this mess, because it's a mess, and we have to just figure out how quickly we can get out of it. And so our focus should be on not having to answer the question of when we will get out of the mess if we don't fix it. We should just fix the mess. And I think there are clever solutions, even if that requires some political will to make that happen. I don't think half-baked solutions like taking RBI's profits and putting them into public sector banks is the way to go. I think that's just like putting a Band-Aid. And actually, it's a pretty bad Band-Aid, in my opinion, as well, because it kind of distances the fiscal authority from the monetary. It reduces the distance of the two. It kind of almost says that a central bank should generate profits because you have to recapitalize the public sector. It's kind of, it just has everything smells wrong about it.
And if there was a government to take these difficult decisions, it ought to be this one, because it's come in with a historic mandate, so to speak, right? Or historic.
We are growing at a decent growth rate. I think this is the time to actually amplify the growth by actually getting the banking sector to be healthy. This is not the time to lay shy, saying, I'm not sure if growth prospects are high. Am I going to be able to collect taxes that I'm going to need to inject this capital into the banking sector? We are growing well. We have tremendous potential. This is the time to clean up the mess.
All right, Professor Acharya, thank you so much for your time, and we're going to leave it there. Thank you very much for speaking with Bloomberg.
Thank you, Mayanka.